Welcome back to the deep dive.
Hello.
We've got quite a stack of sources in front of us today. It's all about a company called SG Mart Ltd.
That's right. They've been making some really interesting moves, pivoting, scaling up, and building materials, especially steel.
Yeah, and we've got the lot. The BSE filing on their board meeting, uh, the full financials for the year and quarter ending March 2025.
Their investor presentation, and even bits from the earnings call. A real mix.
So our job today is to unpack all of this for you. We want to pull out the key bits, the stuff that really matters.
And help you get a quick, clear understanding of SG Mart, their performance, their strategy, what they're planning next.
Basically get you well-informed fast.
Exactly. Let's dive in.
Okay, so performance, where do we start? The numbers for the full financial year, FY25, they look, well, big.
They really do. And you have to remember, FY25 was pretty much their first full year operating under this new SG Mart name and focus. They used to be Kintech Renewables.
Right, big shift from renewables to building materials, steel trading, manufacturing.
And the numbers definitely show that shift is working, at least on the surface.
Working is putting it mildly. Consolidated revenue for FY25 was what, $58,562 million?
Yeah. And compare that to FY24, which was $26,829 million.
Hang on, 118% year-on-year growth, more than doubled.
Precisely. Massive top-line jump. And the profitability kept pace pretty well, too.
Okay, talk about EBITDA.
Right. Earnings before interest, taxes, depreciation, amortization, basically operating profit, that had $1,031 million in FY25.
Up from
$618 million in FY24. So that's a 67% increase. Still very strong growth.
And the bottom line, net profit.
Same story. $1,034 million for FY25. That's up 70% from $609 million the year before.
So huge revenue growth, strong profit growth following it.
Yeah.
What about the most recent quarter, Q4?
Trend continued. Q4 FY25 revenue was $15,950 million. EBITDA, $388 million. And net profit, $331 million. Solid quarter.
And they don't sound like they think this is just a one-year wonder, do they?
Not at all. Management seemed pretty bullish. They actually put out some targets.
Oh, yeah.
They're talking about hitting 200 crores of EBITDA in FY26. That's roughly double the FY25 number.
Oh, double again.
And then double again to 400 crores in FY27. So quite ambitious projections.
Okay, ambitious is right. How on earth are they planning to deliver that kind of growth year after year? Let's dig into the strategy. The sources must break that down.
We do. It revolves around becoming this major trading and distribution hub. Starting point, steel.
Their goal is pretty punchy, isn't it? To be the largest buyer of steel in India.
That's the stated aim, yes. And the way they plan to do it is by focusing really heavily on domestic supply.
Not imports.
Less reliance on imports, more on long-term deals with the big Indian steel mills. They mentioned they're already buying from 4 of the top 6 producers. Seems like a core part of the strategy, predictability and scale through domestic sourcing.
Okay, largest buyer, domestic focus. But they're doing more than just bulk trading, right? You mentioned different verticals.
Exactly. They've structured the business into 4 main areas to capture different parts of the value chain.
All right, let's tick them off. Number 1.
First up is B2B metal trading. This is the classic model. Buy huge quantities direct from the steel producers.
And sell in huge quantities to large industrial customers.
Precisely. They moved about 632,000 tons this way in FY25.
And the outlook there.
They expect sort of mild growth in the first half of FY26, then a sharper ramp up later in the year as domestic capacity increases. Profitability target here is around 750 to 1,000 EBITDA per ton.
Okay, the foundational bulk business. What's vertical number 2?
This is their network of service centers. Here, they move beyond just trading and start doing some basic processing, adding value.
Processing. You mean like cutting steel sheets to size?
Exactly, that kind of thing. Cut to length, making checkered plates, slitting wider coils into narrower ones that manufacturers need. It lets them serve a wider base of, factories and end users.
And they have centers already running.
5 operational ones: Raipur, Bangalore, Ghaziabad, Dubai, and Pune.
Now, didn't the earnings call mention something interesting they learned about these centers?
Yes, this was a key point. They found out these centers are actually way more productive than they first estimated.
How so?
Well, they realized a single center can process maybe 8,000 to 10,000 tons of steel a month. That's getting close to the actual physical capacity, which they put at 13,000 tons.
And what was the initial guess?
Their earlier plans were based on maybe 3,000 or 4,000 tons per center per month. So it's a big difference.
Right, so each center can handle maybe double or even triple the volume they thought.
Yeah.
How did that change their plans?
It made them adjust their expansion strategy. Instead of aiming for, say, 10 or 12 new centers each year, they're now looking at adding 5 or 6 new ones annually.
Why slow down if they're doing well?
The idea is to really push the existing centers first. Sweat the existing centers to the fullest, as they put it. Maximize the return on the capital they've already invested before building out too fast.
Makes sense. And there's a big chunk of capital expenditure planned for this, right?
Yeah.
The 600 crores?
Yes. That 600 crores over the next 3-4 years is primarily earmarked for establishing these new service centers, places like Jaipur, Kanpur, Patna, Hyderabad, spreading the network.
And what's the cost per center, roughly?
Around 30 to 40 crores for the fixed assets, machinery, buildings, that sort of thing.
And the profitability target here, higher than trading?
Yes, significantly higher. They're aiming for around 2,000 EBITDA per ton from the service centers. And they also noted the Dubai center is actually showing better margins than the Indian ones already.
Interesting geographical difference.
Yeah.
Okay, B2B trading, service centers, what's the third vertical?
Number 3 is renewable structures, focusing on the solar industry.
Ah, so products like the frames that hold solar panels.
Exactly. Solar mounting structures. They're selling these under their own brand, Sunstain. It's another processing-based business.
Does this mean building whole new factories just for solar parts?
No, and this is actually quite clever. They're installing the machines needed for these solar structures inside their existing steel service centers.
Oh, so they're kind of adding a production line to the centers they're already building.
Precisely. They leverage the existing infrastructure, the space, maybe some shared overhead. It means the extra capital needed is minimal.
How minimal?
They mentioned something like only 50,000 to 60,000 further investment over the next few years to really scale this up. It's incredibly low for the potential output.
50 or 60,000, not million.
1,000, yes. Seems very low, but that's what the source indicated was the additional investment needed within the existing framework.
Okay, wow. And what's the potential volume and profit here?
They've got order visibility for 50,000 tons in FY26, aiming to double that to 100,000 tons in FY27. And the potential EBITDA is estimated way higher, maybe 3,000 to 4,000 per ton.
That's a big jump in margins.
Huge. And because the investment is so low, the return on capital employed, the ROCE for this solar segment looks really attractive. High profit on very little extra capital.
Very smart way to leverage assets.
Yep.
Okay, that's 3. What's the fourth and final vertical?
The fourth is their distribution business. This is about using their networks, including some links to the APL Apollo group, to sell downstream steel products.
Downstream meaning more finished goods.
Yeah, things like TMT bars,
Yeah.
the ribbed steel bars used in construction concrete reinforcement, and also non-TMT items.
Okay, and wasn't there a change in how they handle the TMT bars?
Yes, a major shift in Q4 of FY25. They moved to a royalty-based model for TMT.
Royalty-based. How does that work with steel bars?
So instead of SG Mart buying TMT inventory, holding it, selling it, and dealing with customer payments.
Which ties up a lot of cash and involves credit risk.
Exactly. Now, they partner with manufacturers. These partners make the TMT bars, sell them under the SG Mart brand name, and SG Mart just collects a fee, a royalty, for each ton sold.
Ah, so they lend the brand, use their distribution reach, but the partner handles the physical stock and the credit.
That's the core idea. It significantly lowers SG Mart's working capital needs and risk profile for this product line. The current royalty is 500 euros per ton.
And the partners are okay with this.
Seems so. The agreements apparently include minimum quantity guarantees from the partners, so SG Mart gets some volume assurance.
What kind of volume are we talking?
In FY25, they did 108,000 tons of TMT overall. But 43,000 tons of that came via this new royalty model just in Q4 alone.
So it ramped up fast. What's the target?
Target for FY26 is 180,000 tons using this model. And they hope to increase that royalty over time, maybe 750 to 1,000 per ton, aiming for an eventual 4 or 5% margin once the brand gets stronger.
But right now, margins are maybe lower because they're investing in building that brand recognition.
That's what they indicated, yes. Near-term brand spending affects the current profitability.
Okay, that covers TMT. What about the non-TMT distribution?
That's things like light structural, steel mesh, binding wire, more standard items. That business was running at about 500 crores annually in FY25, maybe 40 crores a month towards the end.
And the plan there.
Aiming to double it. Target 1,000 crore annual run rate in FY26. The target EBITDA margin here is lower, around 2.5%.
So it's really a portfolio approach. Bulk trading, value-added processing, super low capex solar structures, and now this brand royalty distribution play.
Exactly. Multiple ways to participate in the steel market, all underpinned by those strong relationships with domestic producers they keep emphasizing.
Okay, that gives us a good picture of how they're generating revenue. Let's switch gears to the financial health side, balance sheet, cash flow.
Well,
What did those show?
well, the balance sheet definitely reflects all this growth and investment. Assets are way up across the board.
Like property, plant, and equipment.
Yep. PP&E jumped from about 39 crores to 164 crores. Big increase, reflecting those service center investments.
And inventory. More steel on hand.
Inventory also shot up from 71 crores to 253 crores. And trade receivables money customers owe them went from 86 crores to nearly 317 crores.
So more stuff, more inventory needed, more money tied up with customers. All sounds like growth pains. Yeah, how was it funded? Debt.
Borrowings did increase significantly too, from around 182 crores to 689 crores. So yes, they took on more debt to fuel this expansion.
That all seems somewhat expected with this kind of growth spurt. But you mentioned something stood out in the cash flow statement.
Yes, the operating cash flow for FY25 was negative. They actually consumed cash in their operations, about 2,924 million outflow.
Negative. After reporting strong profits.
Yes, and related to that, their net working capital days jumped dramatically. Went from just 5 days in FY24 to 30 days in FY25.
Okay, hold on. Net working capital days, that's how long cash is tied up in operations, right? Inventory plus receivables minus payables.
Roughly, yes. So going from 5 days to 30 days means cash is locked up for much longer. And negative operating cash flow means the core business, once you account for those working capital changes, wasn't generating cash during the year. That can be a red flag.
So why did this happen? Did the sources explain that spike?
They were very specific about it, actually. They pinned it almost entirely on one large transaction right at the end of the financial year.
Which was?
A big advance payment they made to their steel suppliers in late March 2025. It amounted to 1,507 million.
Over 1,500 crores paid upfront to suppliers just before year-end. Why?
It was stated as a clear strategic move. They wanted to secure a large volume of raw material steel before potential import tariffs were implemented.
Ah, so they were locking in supply and possibly price ahead of a potential market disruption.
That seems to be the rationale presented. A tactical move that happened to hit the books right at year-end, causing that big working capital swing and the negative operating cash flow for the full year.
Okay, so management's line is that this is temporary, not a fundamental problem.
Yes, very much so. They were quite confident on the earnings call, said working capital had already normalized back in May after the year-end.
And they expect it to stay lower.
They expect it to be back in their target range of 10-15 days by the end of the June quarter, so Q1 of FY26. They painted it as a one-off strategic procurement.
Got it. And despite that big cash payment, their overall cash position was still okay.
Yeah, surprisingly strong, actually. They ended FY25 with a net cash position of $4.55 billion.
$4.5 billion in cash, even after that outflow.
Seems so. And they also expect more cash coming in soon.
From where?
From warrant conversions. They anticipate receiving about $2.55 billion in FY26 as warrants are converted into shares.
Right, so the cash pile could grow even larger. How does this tie back to the CapEx plan for the service centers? Can they afford it?
This was another point management really emphasized. They stated very clearly that the entire 600-core CapEx plan over the next few years will be funded entirely from internal cash generation from the operating cash flows.
So no need for more debt specifically for the CapEx.
They said no external debt needed for CapEx. They even said they wouldn't need to touch their existing fixed deposits. The core business is expected to throw off enough cash to fund the expansion.
That's a confident stance. What about those overall return ratios? ROCE. ROE.
Right. Return on capital employed, ROCE, did decrease. It was 43% in FY24 and dropped to 22% in FY25.
That's quite a fall. Why?
It's likely due to the big increase in the capital employed part of the ratio. They've invested heavily in those new service centers, but those assets haven't had a full year yet to contribute fully to profits. So the capital base grew faster than the profit in FY25. It often happens during heavy investment phases.
And return on equity, ROE.
That actually went up slightly from 6% to 9%, and the net debt to equity ratio remained negative, moving from -8.9 to -0.4.
Still negative,
Yes.
meaning more cash than debt.
Correct. Despite the increased borrowing, their cash balance was larger, hence the negative ratio, indicating a net cash position overall.
Okay, so the financials tell a story of rapid growth, strategic investment, a temporary cash flow blip explained by a specific event, and an underlying strong cash position. What about the people side? Any leadership changes?
Yes, one key appointment was announced. Mr. Arkit Arora joined as Vice President for Sales and Marketing. He's also designated as Senior Management Personnel.
New blood at the top. What's his background?
Seems quite relevant. Over 9 years in the steel industry, including time as head of sales for industrial products at Tata Steel, plus executive education from Ahmedabad and Drucker School of Management.
Sounds like they're bringing in someone with serious steel sales experience to help drive that ambitious growth.
That's certainly how it looks, aligning leadership expertise with those big targets.
And just to reiterate those targets.
Doubling EBITDA to 200 crores in FY26, then doubling again to 400 crores in FY27, all while maintaining a minimum ROCE of 25%.
And they mentioned the FY26 target might even be conservative regarding the solar business?
Yeah, they hinted that the full profit potential from that high-margin solar structures vertical isn't completely baked into the FY26 guidance yet, so maybe some potential upside there if it ramps up quickly.
What gives them the confidence for such, frankly, huge jumps?
Management pointed to a few things. Their growing customer base, they mentioned, over 2,200 registered customers now. Also, their supplier base of 225. The diversification across those four verticals we discussed, and crucially, those strong tie-ups with the domestic steel mills, ensuring they can get the raw material they need.
Seems like the supply side security is key to their confidence. And one final practical point, their stock exchange listing.
Yes. They confirmed the process to get listed on the main national stock exchange, the NSE, is actively underway. They're currently on the BSE.
Okay, so we've really unpacked a lot here. Why does this deep dive into SG Mart matter to you, the listener? What's the takeaway?
I think it's a really compelling real-world example of a company in a core industry, steel, undergoing a massive strategic shift and scaling incredibly fast. You can see the mechanics of how they're trying to build a dominant position.
Yeah, and it's not just one strategy. It's seeing how they segment the business, pure trading, adding value through processing, finding these clever low capex niches like solar, and then that royalty model for distribution. It's a fascinating look at adapting business models.
Absolutely. And understanding the nuance behind something like that negative operating cash flow, knowing it was tied to a specific strategic decision about tariffs and supply, gives you a much deeper insight than just looking at a headline number.
Right. It shows how those big picture economic factors can directly influence company actions, even if it makes the immediate numbers look a bit weird.
And it really highlights how different activities within the same company can have vastly different profit profiles. You know, 750 euro per ton on trading versus potentially 4,000 on solar structures. Understanding that mix is key to seeing where the future profit growth might come from.
So wrapping up, SG Mart showed explosive growth in FY25, driven by expansion across multiple business lines, especially those service centers and the distribution network, with solar emerging as a potentially high return area.
We also got the specific explanation for that temporary dip in operating cash flow and the working capital spike, that strategic pre-buy of steel. Seems temporary, based on their comments.
And they've laid out a very clear, very ambitious path ahead. Double EBITDA, then double it again, fueled by domestic steel and a growing, diverse customer base.
Which brings us to a final thought for you to chew on. SG Mart is juggling a lot here. Geographical expansion with new centers, managing 4 distinct business models with different economics, building a brand, as they push this aggressive plan forward.
What do you think will be the single biggest challenge they face in actually executing this complex strategy and hitting those huge targets over the next 2 years? Something to mull over until our next deep dive.